Hi, Larry Berman here, and here's what's on my radar this week. When we're trying to find a tradable market bottom, there's a couple indicators that are my go-to indicators. I love the relationship between front month volatility and back month volatility. So VIX futures comparing to the first month to the fourth month, second month to the eighth month. What you see here on the lower chart is the number of standard deviations of extremeness measured in the relationship between the volatility curve. And when it's up around 2 standard deviations, you can look at the top chart historically, which is the S&P 500, and you can see during other market downturns, depending on the severity, obviously the big jump there in 2020 was COVID. That was a real exception, being close to a 10 standard deviation move. But typically, 2 to 3 standard deviations is where we see this thing spike to. And literally this week, we're very, very close to that 2 standard deviation move there in terms of what's going on here. But we also need to see a complete washout, and market breadth indicators are actually very, very good for that. Big picture, the 200-day moving average and the percentage of stocks above and below the 200-day average are good breadth measurements. There's your S&P, there's the 200-day average. The little red line there is the trend of the last month, obviously down for both. We use that to look for divergences. In the big washouts, COVID, the sell-off at the end of 2018, the percentage of stocks back in 2015, the percentage of stocks below their 200 falls below 20%. Current reading is around 40. We're not quite there yet. So probably not major market bottom. When we look at a more intermediate breadth indicator, we see that the percentage of stocks towards the 50-day average also tends to get very extreme below the 20 level, and we're not quite there yet. We think we need one more dip down for a good tradable bottom, and we could get a rally into month end, post Federal Reserve. That's kind of what we're looking for. So this week, with the Fed on tap, is Powell dovish or hawkish? When we hear from Treasury Secretary Yellen towards the end of the month on what their plans for the Treasury refunding is, it's really important because the US government needs more than $1 trillion this year to fund, and it's sitting there in the repo market in excess reserves. And if she comes with all bills, then we're not going to see a lot of bond stress. But if they decide to distribute that $1 trillion through the curve, at the same time the Fed starts to unwind the balance sheet, that's where financial assets get into real big trouble. And the correction that we've already seen has just begun. So, big week for the Fed. What are they going to do? I suspect they walk it back here, but it's going to be very, very hard to in the face of the building inflation pressure. When we heard Powell's testimony to Congress last week, 2 weeks ago, we heard him say, we have the tools to do this. I don't believe they have. It's going to be a tough sled ahead. We probably get a relief rally at some point here to a significantly lower high than we've already seen. This peak that we've seen in the markets earlier this year, not making a forecast here, but very, very good chance that that's the high we see possibly through 2024. Yeah, I know, it doesn't sound great. That doesn't mean we're going back to these lows at all. Worst case scenario, we probably test this old high and this consolidation sometime in the next 2 years. And that, in order for that to play out, we've got to get a recession. The Fed's got to make a big policy mistake. Some of the big tech names are breaking here. So that's what's on our radar this week. Bull and bear pick of the week. Well, what do we look at here that's bullish from an oversold perspective? So if we're looking at charts relative to markets, where we took money off the table this week, not bearish at all. Very, very bullish, still long term. The potential for uranium and Cameco, given the supply constraints where Kazakhstan supply is probably in the future heading towards China, and them building 100 or 150 plus nuclear plants. That uranium is going to stay in Asia. Cameco is the supply resource that North America needs, and the US in particular, because they do import a lot of uranium from that part of the world that, at least for the foreseeable future, is going to be supply constrained. So we lightened up into the overbought situation here. We look to buy pullbacks. We still like the sector. I think we talked about it as our top pick down here a couple weeks back in our weekly notes. What are we most concerned about? Depending on how this plays out, if we look at some of the base metal plays, so ZMT has been the way, by way of ETF, that we've played. And so this week, last week, we actually, on this reversal here, we took some money off the table in the base metals. Again, we still like it, but from a trading tactical perspective, it's just got very overbought. If we are going into an economic slowdown here, the base metals, while we like them longer term, are going to come off here, and we would look to buy a dip there. Have a great week, everyone.